The Japanese government bond market is feeling the heat today, with the 10-year yield soaring to 2.8%, a jump of 10 basis points. Even more striking, the 30-year yield has crossed the 4% mark for the first time since 1999. Meanwhile, US dollar to Japanese yen is hovering around 158.8. In this video, we'll explore the reasons behind this swift sell-off and what it means for your investments in the Nikkei and yen. As we dive deeper, it's important to note that markets have been grappling with a persistent US-Japan rate differential. Even after interventions near the 160 level in late April, the carry trade remains a strong strategy. Traders are on the lookout for signs of Bank of Japan policy normalization, but the recent spike in yields has taken many by surprise, as global duration stress spills into Tokyo. Today's market movements are influenced by a mix of factors. With crude oil prices hovering around $102, inflation fears are reigniting, which in turn is putting pressure on the producer price index. The 30-year JGB reaching 4.08% marks a significant milestone, indicating a fundamental shift in yield expectations. This bond sell-off has also resulted in a 1.99% drop in the Nikkei, as risk assets adjust to the new higher rate environment. Reactions from analysts in Tokyo are making it clear, Japan is currently the focal point for global duration stress. A macro analyst pointed out that the upcoming Q1 GDP print, anticipated at 0.4%, could serve as the next major volatility trigger. Meanwhile, hedge fund insights reveal that ongoing yen weakness is beginning to impact broader earnings expectations, raising questions about whether the unwind of the carry trade is accelerating. Mechanically, rising JGB yields should ideally support the yen. However, US dollar to Japanese yen remains stubbornly near 159. This indicates that the Fed's higher-for-longer policy is still outweighing any moves from the BOJ. For traders in the Nikkei, this presents a double-edged sword. A weak yen typically boosts exporters, yet the rapid rise in domestic yields is negatively affecting valuations across the board, particularly in interest rate-sensitive sectors. In the realm of fiscal policy, the Japanese press is buzzing about a potential extra budget aimed at easing the burden on households facing rising oil costs. This proposed fiscal expansion, linked to Takaichi's policy plans, is raising eyebrows regarding debt sustainability. Market participants are concerned that these debt-funded relief packages could clash with the Bank of Japan's normalization efforts, complicating Governor Ueda's path forward. As we assess positioning and flows, leveraged accounts are becoming increasingly cautious around the 160 zone, where intervention from the Ministry of Finance becomes likely. We're witnessing a decline in broad Nikkei beta exposure, with traders shifting towards selective long positions in sectors like autos and semiconductors that stand to benefit from yen translation. Real money accounts are particularly attentive to the 4% level on the 30-year JGB for potential re-entry opportunities. Looking ahead, keep an eye on the 159.50 to 160.00 range for US dollar to Japanese yen. A breach here could prompt verbal intervention from the Ministry of Finance. Tomorrow's Q1 GDP data is crucial. If it exceeds expectations, we might see a stronger yen, but a miss could push US dollar to Japanese yen to new heights. Additionally, monitor the 10-year JGB yield. If it maintains 2.8% as a floor rather than a ceiling, the duration sell-off could have further implications. In our scenarios moving forward, a strong GDP print and rising PPI could push the 10-year yield toward 3%, potentially triggering a yen rally to around 155. Conversely, a GDP miss may lead the BOJ to maintain an accommodative stance, pushing US dollar to Japanese yen past 160 and necessitating immediate MOF intervention. Our baseline expectation is that US dollar to Japanese yen will hold between 158 and 159, while the Nikkei remains under pressure from yield volatility. To summarize, the new reality features the 10-year JGB at 2.8% and the 30-year at 4.08%. Keep an eye on the 160 level for potential intervention and 158.30 for support in US dollar to Japanese yen. The future path of the Nikkei hinges on the stabilization of domestic yields. Stay alert for tonight's GDP print. For daily insights on Tokyo macro trends tailored for traders, consider subscribing to Tokyo Macro Daily.